welcome back to the Deep Dive. Today, we are not just talking about a stock ticker. We're not, just looking at quarterly numbers or some standard earnings beat.
No, this is much bigger.
We are looking at a massive corporate shape-shifting event. I mean, we are witnessing a titan of American industry, a company that's been a monolithic fixture for over a century, and it's in the middle of tearing itself apart. On purpose.
It's the classic sum-of-the-parts story, but on a scale, and frankly with a level of complexity we almost never get to see play out in real time.
Exactly. And the subject of our investigation today is Honeywell, ticker symbol HON. Now, I know what you're thinking. Honeywell, the beige thermostat on my grandmother's wall.
Right. Or the fan heater you bought when your furnace went out.
The very same one. But that's exactly why this deep dive is so necessary. Because if you think Honeywell is just thermostats, you are missing about, 95% of the story?
Right. At least. The reality is that we're looking at a definitive pivot, and the timing is key here. We are standing here on Saturday, January 31st, 2026. The Q4 2025 numbers just dropped a couple of days ago.
They're still hot off the press.
And the company has confirmed that this historic breakup isn't just happening, it is accelerating.
Right. They're pivoting from this kind of clunky, massive industrial conglomerate into what they hope will be 3 razor-sharp, independent public companies.
And to get to the bottom of this, we've pulled a massive stack of sources. We've got the Q4 2025 earnings transcripts that literally just came out. We have the 2026 strategic roadmap, investor presentations from Goldman Sachs and Baird, and some very fresh, very detailed analyst upgrades from JP Morgan and Seeking Alpha.
And our mission today is to generate a granular investigative report on this split. Is this a chaotic breakup where they're just, throwing things overboard to save the ship?
Or is this a masterclass in unlocking value? That's the question.
That's the billion-dollar question, or in this case, a couple $100 billion question. So let's unpack this. Before we get into the nitty-gritty of the spin-offs and the IPOs, we need to understand what we're actually looking at. What's the context here? Why does a company this big decide to stop being big?
The context is entirely about valuation. For years, Honeywell has traded with what we call a conglomerate discount.
Okay, break that down for us. The conglomerate discount.
The market looks at this massive beast that makes jet engines and warehouse scanners and quantum computers and chemical catalysts, and it says, it's too complex.
I don't get it.
I don't know how to model this. I don't know how to compare it to a peer because it has no direct peers. So what happens? They just say, we're going to value it lower than the sum of its parts.
It's like buying a house that comes with a boat, commercial kitchen, and a horse stable.
Yeah.
You might just want the house, so you aren't willing to pay full price for all the other stuff you don't really understand or want.
That's a great analogy, and that's exactly what investors have been telling Honeywell for years. We want the jet engines, but we don't want to pay a premium for the warehouse conveyors. The theory is, if you break them apart, the sum of those individual parts is worth far more than the whole.
And the clock is ticking. We're sitting here at the end of January 2026. The separation of the aerospace business is looming. So let's dive into the architecture. Before they rip this company apart, what is actually inside the box? Because it's not just one business, it's really, 4 distinct engines running at the same time?
That's right. As of the new reporting structure, which is effective right now, Q1 2026, we are looking at 4 specific segments. And the biggest one, the absolute monster in the room, is aerospace technologies.
This is the one everyone is watching. This is the crown jewel.
Without a doubt. It's the growth engine of the entire enterprise. And the phrase you'll hear the executives use over and over and over in the transcripts to describe their dominance here is nose to tail.
Meaning they make everything from the front of the plane to the back?
Pretty much. If you step onto virtually any aircraft platform in the free world, whether it's a Boeing 737, a Gulfstream business jet, or an F-35 Fire Honeywell content is on it. And we aren't just talking about a few bolts here. We are talking about the electronic solutions unit, which is, for all intents and purposes, the cockpit. Specifically, their big new system is called Anthem.
Pause there for a second. Anthem. That sounds like marketing speak. What actually is it that makes it so special?
Think of Anthem as the operating system for the plane. In the past, cockpits were just gauges and dials, or maybe a few disconnected screens. Anthem is a cloud-connected, always-on flight deck.
So online?
It's always online. It connects the plane to maintenance crews on the ground in real time. It can predict when a part might fail before it actually does. It handles the flight management computers, the literal brains of the plane that calculate fuel, route, and trajectory. It's a huge leap forward.
So it's really moving from analog to digital. It's the iPhone moment for the cockpit.
That's a perfect way to put it. But they don't just do the software and the screens. They do the heavy metal, too. They have the engines and power unit. They make the massive jet engines for business aviation, your Challengers, your Gulfstreams. But they also make the APUs, auxiliary power units.
Okay, explain that to me like I'm 5. What is an APU? I see that acronym everywhere in these reports.
You know when you board a plane and the main engines under the wings aren't spinning yet?
Yeah.
You're walking down the jet bridge, you get on board, the lights are on, the air conditioning is blowing, and you hear that high-pitched whine coming from the back of the plane.
Yes, loud and clear, usually right when I'm trying to stuff my bag in the overhead bin.
That sound is a small gas turbine engine hidden in the tail of the aircraft. That is the Honeywell APU. It's what provides all the electricity and air pressure to the plane when the main engines are off. Honeywell has a massive, almost monopolistic market share in that specific critical niche.
I had no idea that was them. It's it's ubiquitous. You hear it on every single flight. And what about the third part of aerospace?
That would be control systems. This is the stuff that keeps the plane functioning physically. We're talking about wheels, we're talking about high-performance carbon brakes, and crucially, thermal management.
Thermal management. That sounds like more than just air conditioning.
Oh, it's way more critical than that. Modern planes, especially military jets and ones with heavy electronics like the 787, generate immense amounts of heat. Honeywell makes the specialized heat exchangers and cooling loops that keep all those vital electronics from frying at 40,000 feet. So if you look at the whole picture...
Yeah, the brains with Anthem.
The muscle with the engines and APUs.
And the nervous system with the controls.
You've got it. It's an incredible footprint.
And from the earnings reports, it looks like the revenue split is really interesting. It's not just commercial travel, right? Because if another pandemic hits, commercial travel dies, and investors get nervous about that kind of exposure.
No, and that's a key stabilizer for this stock, a huge part of the investment thesis. It's roughly 60% commercial aviation and 40% defense. So it has that balance. And the defense niche is fascinating right now. In the transcripts, they talk about the Golden Dome concept.
That sounds like a sci-fi movie. Or secret society. What is the Golden Dome?
It refers to their missile defense technology. We're talking about advanced anti-jamming systems, guidance computers, and actuation systems for missiles. In a geopolitical environment that is, shall we say, tense.
Understatement of the year.
This business is booming. And a crucial detail for investors, something that really jumped out in the notes from Baird. This isn't just foreign military sales or FMS.
What's the difference? Why does that matter?
FMS is government to government. The U.S. government buys it from Honeywell and then sells it to an ally. It's slow, there's a lot of red tape, and the margins aren't as good. What Honeywell is seeing is a surge in direct international sales.
So they're cutting out the middleman.
They're selling directly to allied nations. That usually means much higher margins because there is less administrative overhead and they can price more aggressively. It's a much more profitable sale.
Okay, so that's Engine 1, Aerospace, the Beast. Now let's look at Engine 2, building automation. This is the one that feels closer to home for most people, but you're saying it's much more than just a thermostat.
Much more. In fact, calling it a thermostat business is almost an insult at this point. This segment is described by the CFO on the earnings call as the crown jewel of the automation portfolio, and there's a reason for that.
Which is?
The focus here is efficiency and safety, but the real story is the business model shift. They're moving from selling hardware like fire alarms and sensors to selling software. You'll hear them mention Honeywell Forge.
Obviously, that's their cloud platform.
Exactly. It's all about connected life safety. Imagine you run a massive hospital system or a global hotel chain. You don't just want a fire alarm that beeps. You want a single system that integrates security, energy management, and air quality, all accessible from the cloud. You want to know if the HVAC in room 302 in your Tokyo hotel is failing before the guest complains. That kind of predictive maintenance and control generates recurring software revenue, which Wall Street absolutely loves because it's predictable and high margin.
It changes the customer from a one-time buyer into a long-term subscriber.
Precisely. And I notice in the transcripts they keep mentioning a specific vertical that is just on fire right now, driving growth here. And it's the hottest sector in the entire market.
Data centers.
Data centers.
I saw that too. But I always associate data centers with NVIDIA chips or Microsoft servers. How does Honeywell fit into the AI boom?
You have to understand the physics of AI. Those AI chips, those racks of NVIDIA servers, they generate heat like a blast furnace. It's an incredible amount of energy. You simply cannot run a modern data center without extremely sophisticated cooling and power management.
So if the cooling fails, the AI dies.
Exactly. And Honeywell Building Automation is providing the advanced cooling controls, the power management, and the physical security for those facilities. They are the critical infrastructure layer that allows the AI revolution to physically exist. It's a massive high-margin compounder.
Okay, so we have aerospace flying high, building automation keeping the internet cool. What is the third engine? This one is a bit of a mouthful. Process automation and technology, or PA&T.
Right. This is a newly formed segment for 2026. They've combined two things under one roof, a business called UOP and another called Process Solutions.
Let's break down UOP. I always see those three letters associated with Honeywell, but I've never really understood what they do.
UOP is essentially a massive high-end chemistry lab. They design the chemical recipes, the catalysts that allow a refinery to turn crude oil into gasoline or natural gas into plastic. They license that technology and sell the catalysts. It's incredibly high-tech chemistry and process engineering.
And process solutions. What's that part?
That's the software and controls for those very same plants. So UOP tells you how to make the gasoline, and Process Solutions gives you the computer system and the control screens to actually run the factory that's making it. They go hand in hand.
And looking at the Q4 2025 notes, this seems to be a tale of two cities. There's a real split here.
It is. You have to understand the dynamic between long cycle and short cycle businesses here. It's key to understanding their performance.
Break that down. What defines a long cycle versus a short cycle in this industry?
Think of it in terms of the timeline of the purchase. A short cycle is like buying printer ink for your office printer. You run out, you buy more immediately. In this case, it's replacement catalysts for existing chemical plants. It's a quick transactional sale.
Okay.
A long cycle is building the printer factory itself. These are massive, multi-year, multi-billion-dollar construction projects.
Got it. So what's happening in 2026? Which one is winning?
The long cycle stuff is absolutely booming. We are talking about massive LNG liquefied natural gas projects and new refinery projects. Orders there were up a staggering 17% in the second half of 2025. The world is building energy infrastructure like crazy, partly to secure energy independence after, recent geopolitical events.
That's very robust.
It is. But the short cycle side, specifically the petrochemical catalysts, is weak. The market is oversupplied right now. There's too much chemical production capacity, particularly in China. So companies aren't running their plants as hard and they aren't buying as many replacement chemicals.
So you have this weird dynamic.
You do. The project backlog is huge. The future looks great. But the day-to-day sales of chemicals are soft. It makes the quarterly numbers look a little lumpy.
That brings us to the fourth and final engine, which I think is where a lot of the historical confusion lies.
Yeah.
Industrial automation. Because didn't that used to be just everything else?
It used to be the catch-all bucket, the garage sale of Honeywell. But this is where the purification strategy comes in. And this is crucial for you, the listener, to understand. They are stripping this segment down to the studs.
Stripping it down to what? What's left?
Exclusively to sensing and measurement. We are talking about high-end, high-margin sensors for medical devices, industrial pressure sensors, transport sensors for trucks and planes. The goal is to make this a pure-play, high-margin, high-tech business.
But to do that, they have to get rid of the heavy stuff.
They do.
And that leads us perfectly into Section 2. The strategic inflection point, the breakup plan, because they aren't just keeping these four engines together, they are ripping the biggest one right out.
This is the headline event, the one that gets all the attention, the aerospace spinoff.
Ticker symbol HONA.
HONA. And the big news from the earnings call on January 29th was the accelerated timeline. Originally, the market thought this might drift into late 2026, maybe even early 2027. Management has now confirmed it's accelerated. We are now looking at Q3 2026.
That's fast. That's only 2 quarters away from now.
It is very, very fast for a spin of this magnitude. It suggests they have their ducks in a row and they're ready to go. They're not messing around.
So, remind us of the why. Why go through the immense headache of splitting up a company that has been together for a century? Is it just to make the spreadsheet look nicer for analysts? Or is there real money to be made here?
It comes back to that valuation multiple we talked about. Let's do the simple math. If you look at pure-play aerospace companies like GE Aerospace, which just split recently, or RTX, formerly Raytheon, they trade at much higher price-to-earnings multiples than a diversified conglomerate like Honeywell currently does.
So for every single dollar of profit, The market is willing to pay more for the stock if it's just an aerospace company.
Exactly. A conglomerate might trade at, say, 18 or 19 times its annual earnings. A premier aerospace and defense contractor might trade at 25, 28, even 30 times earnings. By setting aerospace free, the theory is that HON will immediately re-rate to that higher valuation. It unlocks billions in trapped value overnight.
It's basically valuation arbitrage.
It is, pure and simple, and they have the team to do it. We learned the leadership lineup. Jim Courier will be CEO, Josh Jepsen as CFO. But the name that caught my eye, and the name analysts are really circling in their reports, is the non-executive chair, Craig Arnold.
Why does that name matter so much?
Well, I was looking at his background. He comes from Eaton Corporation, and in the industrial world, Eaton is legendary for operational excellence. They are known for being lean, incredibly efficient, and ruthlessly disciplined with capital allocation. Putting him as chair feels like a very, very specific signal to Wall Street.
It sounds like they are saying, we aren't just building cool jets. We are going to run this business with ruthless world-class efficiency.
Precisely. It signals that HON will be a profit and cash flow machine, not just an engineering shop. It's a message of financial discipline.
Okay, so aerospace goes out the door in Q3. But we mentioned the purification of the remaining automation business. This involves selling things off, not spinning them. What's the difference?
It's a key distinction. A spin-off gives shares of the new company to the existing shareholders. A sale, a divestiture, just brings cash into the parent company. And they've announced they are divesting two major businesses: productivity solutions and warehouse and workflow solutions, which includes the big Intelligrated business.
Intelligrated, that's the warehouse logistics stuff, right? The conveyor belts, the automated sorters for Amazon and FedEx warehouses.
Exactly. They bought Intelligrated a few years ago for a lot of money. But here's the problem. That business is capital intensive. It's heavy. You have to build massive steel structures. It has lower margins compared to software or advanced sensors.
It drags down the average margin profile of the whole company.
It does, and the new strategy is clear. Honeywell wants the remaining company to be in automation and controls company-think code and sensors, not a logistics company that's bending metal for warehouses.
So they're selling the heavy, lower-margin stuff to focus on the high-margin, intellectual property-heavy stuff.
That is the strategy in a nutshell. And they plan to have these sales done in the first half of 2026. So by the time the aerospace spin happens in Q3, the RemainCo, the company left behind, will already be a lean, mean, high-margin machine.
And we should briefly mention one piece of the puzzle that is already gone, just to close the loop.
Right. Solstice Advanced Materials, ticker SOLS. That spinoff happened back in October 2025. It's done. It's out there trading as its own company. It's no longer a financial headache for Honeywell. So that chapter is closed, but it shows they have a track record of following through on the plan.
Okay, so the plan is spin Aero, sell warehouses, and keep the high-tech automation. It sounds clean on paper. But let's get into the financial realities. We just got the Q4 2025 numbers, and honestly, looking at the headlines, it seemed a bit messy.
Messy is the perfect word, and that's to be expected during a breakup of this size. If you just looked at the top-line revenue of $10.1 billion, it was a slight miss or mixed, depending on which analyst you ask. But the earnings per share, the EPS, was $2.59, which beat expectations by about 5 cents.
So why the mixed signal? Why did revenue look a bit soft if profits were strong?
It's the noise of the divestitures. When you are selling businesses and moving segments around, the year-over-year comparisons get very murky. You're comparing a bigger company last year to a smaller one this year. But, and this is the big but that you have to dig for, if you strip away all that noise and look at organic growth, the picture changes completely.
Here's where it gets really interesting. What were the organic numbers?
Organic sales were up 11%. That is double-digit growth in an industrial giant. That alone is impressive. But the number that really jumps out, the number that tells you what 2026 will look like, is organic orders. They surged 23%.
23% order growth. That is massive. That does not sound like a company that's in trouble or struggling.
It proves that the core engines, aerospace, and project automation are running incredibly hot. Despite all the corporate surgery, despite the distractions of the split, the customers are still buying, and they're buying in huge quantities.
And that leads directly to the safety net. I saw this number in the Baird report, and my jaw just dropped. The backlog.
It's a record. $37 billion.
$37 billion of work that is already sold and just needs to be delivered.
Think of that as a buffer. It's a fortress. Even if the global economy slows down in 2026, even if there is a recession, Honeywell has $37 billion of revenue locked in. They just have to execute and deliver the products. That backlog is primarily driven by aerospace and those long-cycle process automation projects we talked about. It gives them incredible visibility.
Now, restructuring is expensive. Splitting companies costs a lot of money. You're paying lawyers, bankers, rebranding. How are they paying for all of this?
They are printing cash. The free cash flow guidance for 2026 is between $5.3 billion and $5.6 billion.
That's a lot of liquidity, a
Yeah.
lot of dry powder.
It is. And the strategy they laid out on the call is to use that cash to pay down debt before the breakup. They want to ensure that when HON Aerospace and the new automation company start their lives apart, they both have clean, pristine, investment-grade balance sheets. They don't want to saddle the new kids with too much debt from the get-go.
That's smart. It's like paying off your credit cards before you and your partner move into two separate apartments.
Exactly. It sets both new companies up for success from day one.
Okay, let's pivot. We've talked about the big known engines, but there is something else lurking in this portfolio. It's not a thermostat, it's not a jet engine, it's something that sounds like it belongs in a sci-fi novel.
You're talking about the hidden catalyst, the wild card.
Quantinuum.
Yes. This is Honeywell's majority-owned quantum computing subsidiary. They own 54% of it.
And for a long time, this felt like a science project. You know, oh, Honeywell is dabbling in quantum computing. It was a cool line in the annual report. But the numbers here are getting very serious.
Very serious. They recently raised a new round of capital for Quantinuum, and the key number here is the valuation. It was done at a $10 billion pre-money valuation.
Hold on, $10 billion for the whole company.
$10 billion. Now, you do the math. Honeywell owns 54%. That means Honeywell's stake is worth roughly $5.4 billion.
That is value that is currently sitting hidden inside the Honeywell stock price. Most people buying a boring industrial stock don't realize they also own a massive stake in a leading quantum computing company.
Exactly. It's currently buried in the conglomerate structure. The market is not giving them full credit for it because it's opaque.
But that's about to change.
Yes. The big catalyst here, confirmed in the strategic roadmap, is that a confidential draft registration for an IPO is planned for 2026. They are going to take this public.
So that value is about to be crystallized.
Yeah.
If they IPO anywhere near that valuation, suddenly that $5.4 billion becomes real liquid value for Honeywell and its shareholders.
And this isn't just a theoretical company. I saw they just launched their Helios computer.
Helios.
It's their latest generation quantum system. But perhaps more importantly for the commercial story, they are partnering with the kings of AI. They have announced deep collaborations with NVIDIA and Google to integrate quantum computing with artificial intelligence.
Now, why does AI need quantum? I thought AI ran on GPUs.
It does. But there are certain classes of problems, like simulating molecular structures for new drugs, or optimizing massive global logistics networks, or designing new materials that are too complex, even for the biggest supercomputers. That's where quantum comes in. By plugging quantum into the AI workflow, they're moving it from a science project to a commercial reality very, very quickly.
So for the Honeywell investor, this serves as a massive potential upside, a lottery ticket, if you will, that traditional industrial investors might be completely overlooking because they are too focused on jet engine supply chains and building controls.
It's the ultimate wild card. And it's a wild card with a potential $10 billion price tag.
Speaking of supply chains, we have to talk about the risks. It's not all smooth sailing. There are definitely headwinds. What are the gritty details that could trip them up on this journey?
The first one, and the one management spent the most time on during the Q&A, is what we call stranded costs.
Okay, explain that for us.
When you have one big company, you have one HR department, one IT department, one legal team. That's corporate synergy. When you split into 2 or 3 separate public companies, suddenly you need 3 HR departments, 3 IT systems, 3 general counsels. You lose that synergy. The costs that are left behind, the corporate overhead that doesn't go away immediately, are called stranded costs.
So margins could take a hit right after the split because you're duplicating all this bureaucracy.
Exactly. It's expensive to be apart, at least at first. Management has a plan, they say, to neutralize these dyssynergies within 12 to 18 months post-spin. But that is the big execution risk. If they don't cut those costs fast enough, margins will bleed and Wall Street will punish them for it.
So that's an execution risk we need to watch very closely in late 26 and 27. Okay, risk number 1, stranded costs. What's risk number 2?
Supply chain bottlenecks. but it's nuanced. A year or two ago, the problem was electronics, semiconductors, chips. That's mostly fixed now. The problem has shifted to mechanical components.
You mean castings and forgings?
Exactly. The specialized heavy metal parts that go inside a jet engine. These are high-temperature, high-stress components made from exotic alloys. You can't just 3D print them easily yet. There are only a few foundries in the world that can make these high-spec aerospace castings, and they are all backed up.
So this constrains their growth.
It constrains how fast Honeywell can build engines to meet that huge $37 billion backlog. They have the orders, we know that from the 23% order growth, but can they physically build them fast enough to recognize the revenue? That is the physical constraint on their growth right now.
And then there was a very specific one-time item in the Q4 report about a big settlement, Flexjet.
Right. This was a Q4 2025 event. There was a nasty dispute with Flexjet, a major private jet operator, over engine maintenance contracts. It got pretty ugly.
Is lawsuit ugly?
Yes, full-blown litigation. But in Q4, they settled it.
What was the financial damage?
It had a $373 million profit impact in the quarter. That's a significant hit, and it's part of why the reported numbers looked a bit messy. However, and this is the key, the settlement also secured a long-term maintenance contract with Flexjet all the way through 2035.
So they took a short-term punch to the face financially to lock in a decade of guaranteed high-margin revenue.
Precisely. It removes a massive legal cloud that was hanging over the aerospace division right before the spinoff. If they hadn't settled, that lawsuit would have been a huge red flag for the new HON investors. Now it's clean. They're clearing the decks.
So we have the pieces of the puzzle. We have the breakup plan, the financials, the hidden quantum gem, and the risks. The big question is, what is the final verdict from the people who do this for a living?
If you look at the analyst community, JP Morgan just upgraded them. Seeking Alpha has a strong buy. The major banks are all positive. The consensus is shifting rapidly to a high conviction buy.
Buy now, before the breakup actually happens.
Yes. The logic is all about capturing that arbitrage. Right now, you can buy the whole of Honeywell at that conglomerate discount we talked about. You're buying it for less than its peers.
And then what happens? Walk me through the mechanics of the payout for an investor.
Okay, so you buy shares of HON now. You hold them through Q3 2026. Then one day, you receive shares of the new aerospace company, HRAO, as a tax-free dividend. You don't pay for them. They just appear in your brokerage account. The expectation is that those HONA shares will immediately trade up to a higher multiple, similar to where GE Aerospace or RTX trade.
So you get that immediate growth pop from the aerospace re-rating.
And you still keep your original shares, which are now RemainCo, the leaner, higher-margin automation business, which, after shedding the warehouse stuff, becomes a very attractive dividend-quality industrial stock in its own right.
Plus, you still have the lottery ticket.
Plus, you still have the embedded value of the Quantinuum stake, which is set for its own IPO windfall later in 2026. It's really a three-layer cake of value creation.
Is there a counterpoint? Who is saying stay away or hold?
There is a wait-and-see camp. Some analysts have it rated as a hold because, look, spinoffs are messy and complicated. They worry about those stranded costs we mentioned. They worry that the industrial economy might tank before the spin happens. They say, why risk the volatility? Just wait until the split is complete and then buy the pure play aerospace company directly if that's what you want.
But if you wait, you miss the free distribution of shares.
And you almost certainly miss the initial re-rating. Usually, the bulk of the value unlock happens at the moment of the spin or in the days leading up to it. If you wait until after the dust settles, you might be buying in at a much, much higher price.
That makes sense. I love the quote one analyst from JP Morgan gave in his report. He said, risk defined, portfolio protected.
It sums it up perfectly. The $37 billion backlog protects the downside risk they have work to do regardless of the economy. The spinoff and the other moving parts are all about unlocking the upside potential.
So let's wrap this up. We've gone from a confused industrial giant to what will soon be a focused aerospace titan, a lean automation player, and a potential quantum pioneer.
It's a transformation of historic proportions. It is really rare to see a company this old, this entrenched, reinvent itself this aggressively and this quickly.
And here is a final provocative thought for our listeners to mull over as we close. We tend to think of the RemainCo, the automation business, as the boring part that gets left behind after the sexy aerospace business leaves. But think about this. They're the ones who will still own 54% of the quantum computer company. They own the Forge software platform. They're partnering with Google and NVIDIA on AI.
I see where you're going with this.
Post-2026, if Quantinuum really takes off and that IPO is a success, does old-school Honeywell automation actually morph into a high-tech, AI and quantum play. Is the boring industrial company actually a tech stock in disguise?
It's a fascinating possibility. If the industrial automation, the sensors, the controls for buildings and factories, gets powered by their own in-house quantum computers and AI, the valuation ceiling completely disappears. It stops being valued like an industrial stock and starts being valued like a technology platform.
That is something to watch. Keep your eyes on that Q3 2026 spin-off date. It's going to be a wild year for Honeywell. Thanks for listening to The Deep Dive.
Thanks for having me. It was a great discussion.